Well, I'm Brian Livingston. I write a column for stockcharts.com twice a week, and I write columns other places on my own monthly newsletter. This relates to my latest column for Stock Charts, which is titled, "To Make More Profit in the Market, It Helps If You're Brain Damaged." That is based on some findings that people who have a damaged or non-functional part of their brain that controls their emotions, that controls their fear, if they have a lesion or some kind of a tumor that interferes with that section of the brain working, they actually perform better on simple investment games than normal people who have no brain damage at all. That's very unusual. You can see in this particular game that the researchers played with these brain damaged people and with normal people, that the people who had no experience of fear made about 28% in an investment game, and people who had normal brains made about 14%. So the people without this area of their brain that controls fear had double the gain of the normal people, and we can learn from that. We can take advantage of that in our own investing. The way that the game was structured is that the researchers met with the people in the study one at a time and gave everyone 20 $1 bills. So you have $20. There will be 20 rounds of coin flipping. Each time you get the choice of invest $1 or hold back and not invest $1. If the coin came up tails, you would win $2.50. But if the coin came up heads, you would lose your $1, lose your total investment. So after 20 rounds of this, what was the difference? Why did the people who had some brain damage make twice as much gain as the people who had normal brains? It's because when the coin flip went against them and they lost their investment, the people who were brain damaged bid again the next time. They chose to invest in about 86% of the time. The people who had no brain damage experienced fear of loss, and they chose to invest in the next round only 40% of the time. That's a big difference. That is the way a lot of us investors experience the market, is it just went down 1%, so now I'm going to pull out. Well, that's too short term. That's very much reacting to noise. So what we can learn from this, my entire article is at this short URL, bri.li/190507. That's a lot easier to type in than the whole URL at stockcharts.com. So I encourage you to write this down. Don't go there now until the show is over. But this gives you all the information about this, and I plan to follow this up with some additional columns. Let's go on to something else. Our beliefs and our behavioral biases are big factors in how well we do with our long-term investments and even our short-term investments. What do we hear when the market calls to us? Usually it's a wrong number. We get a lot of signals, we get a lot of noise. When we react to noise, when we react to short-term signals, we often are just making a mistake. So people have been researched by academics. They have been studied by people who got access to all of their trades with all of the personal information taken out. And here is the result. If you look at the investors who got rid of some mutual fund because it had had an underperformance in the last 3 years, and they bought some other mutual fund, what happened in the second 3 years is that the fund they divested themselves of did better than the fund that they bought. So we have this unfortunate tendency to equate the performance of the last 1, 2, or 3 years with the performance in the next 3 years. That, unfortunately, is a fallacy. There is a reversion. The technical term is reversion to the average. Academics call it reversion to the mean. It's the same thing. The market and securities in general have a tendency to have a hot streak for maybe 2 or 3 years, and then they'll have a cold streak for 2 or 3 years. If we try to chase that, we will just be selling securities that will do better in the future and buying securities that will do not as well. So let's look at our 3-year experience. We're in 2019 now, obviously, and in the last 1, 2, 3 years, the market has mostly been up, up, up. Of course, we've had a correction in the fourth quarter of 2018, but now we have had new highs recently, And so it looks like maybe we're okay. Maybe the market isn't going to go down. Maybe it'll just keep going up. You have to wonder if we can't rely on the experience of the last 3 years, what can we rely on? Here's what is the experience of people who are professional money managers, people who are institutions, who hire outside money managers. It's very shocking that 100% of the institutions that manage money using outside managers fire managers who underperform in the past 3 years. Actually, 40% of the active managers get fired after only 1 year of outperformance. If you're talking about managers of smart beta portfolios that are weighted in some way other than the market capitalization of the portfolio, the institutional funds fire outside money managers within 1 year of underperformance 80% of the time. And again, 100% of the outside managers, and this is a study of thousands of major financial institutions that hire outside money managers, 100% of the outside money managers are fired with 3 years or less of underperformance of some benchmark that they may have. When we look at the specific results of the managers who were fired and the managers who were hired, we can see that the investment institutions chose to get rid of outside money managers who had outperformed their benchmark, but not by as much as other outside money managers who did really, really well. On the left side of this graph, we see that the money managers who were fired had beat their benchmark by 2 percentage points. But the outside managers had a really good run of luck and outperformed their benchmark by 11 percentage points. After the firing of the underperforming asset managers who were actually outperforming, but not by much, and the hiring of the outside money managers who'd performed very well, you see on the right side of the chart that the managers who were brought in the next 3 years only beat their benchmark by 3 percentage points, and the managers who were fired went on to a performance of beating the benchmark by 4 percentage points. The institutions would have been better off staying with the people who had had a cold streak because securities revert to the average. Those people and those securities that have a cold streak will often have a hot streak after that. So looking at 2019, we really can't trust what we see from the experience of 2017 and 2018 when we are looking for what the market might do in 2019, 2020, and 2021. It's just a fallacy that we think the recent past is going to be repeated in the future. What's true is that the recent past may just come back to the average. It may just revert to its usual growth. The stock exchange in the United States grows about 6% per year on the average, plus inflation, which brings it up to about 9% a year when you consider inflation. And we can count on that, but we can't count on that every year, and we can't project from the last 3 years what the next 3 years will look like. Researchers did another study which shows how much the investors would have made if they had followed the strategy of the last 3 years and followed it for the next 3 years. This text is very small, but I'll read you the top line. Only the top line is really important here. If you followed the investment strategy that was in the top of performance in the last 3 years, your raw return on the top line here would have been 8%. If you had instead chosen to follow for the next 3 years the investment strategy that had been right in the middle of the past 3 years, you would have made about 9.7%, which is about 1.5 percentage points more. And surprisingly and shockingly, if you had decided to follow for the next 3 years strategies that had been in the very bottom of performance in the previous 3 years, your raw return would have been 10.4%. That's more than 2 percentage points higher than following what strategy was the winner in the last 3 years. So it's really something that is contrary to human nature. It's contrary to our intuition. We think that things that have been happening for the last 2 or 3 years are going to keep happening, and that's not what the market tells us. The market tells us that it is going to revert back to average. Those who are on top will not be on the top in the next 3 years at all. So we need to construct our portfolios by paying attention to the things that are important and leaving out the things that are just noise. We can do that, hopefully, by learning to use a style of investing that works for us, a style of investing that really tries to tune out the noise and tune in the signal of what the market is telling us. One of those systems is in a class of investing strategies that are called mechanical investing. So in this illustration, we see there are dozens of different styles of investing. You have options on futures, you have currency trading, and all of that. But most investors in the United States and elsewhere use one of three styles of investing. You can use passive investing, which is just to invest in several different asset classes and hold them for years. You can use active investing, which is doing research, and then acting based on your opinion, what you should get rid of and what you should buy, which, as we've seen, people usually guess wrong. Or we can use mechanical investing. That means following a formula, relying on the formula, letting computers do what they do well, which is crunching the numbers and coming up with a rating system, and following that rating system without imposing our own opinions on top of it. To get all of these illustrations and to get more background on what these studies show, go to this URL, bri.li/190409. That leads to the top of a series of articles that I've done on all of these charts and more. Any comments?
Oh, yeah. Okay. Actually, I'm looking. Let's see. Does reversion to the mean suggest better opportunities can be found by buying on pullbacks?
Well, what we need is a mechanical formula. That's my feeling, just to impose my opinion on it, that we as human beings are programmed by our DNA to guess wrong when confronted with the noise of any stock exchange. There are earnings, there are predictions, there are analyst reports, there's all of this sound and fury that comes out to us about the market. If we can boil it down to what is really important for us, which is how much money am I going to make in my portfolio over the next complete bear bull market cycle? On the average, a bear bull market cycle is about 8 years. In this case, we've had a bull market for 10 years. That's not the longest bull market in history. The market from the 1987 crash to the top of the 1999 through 2000 peak, that was 13 years. So you can have a 13-year bull market. We're not at all able to say that the market will crash this month or next year or at any time. The market crashes due to some shock, some disbelief in the system, some fear that other people are getting out, so I'd better get out. That can't be predicted. But what we do know is that diversifying our portfolios is a great way to gauge how much risk we're going to take and to prevent ourselves from feeling fear and feeling panic when the market does turn down. So a great question for us is, what ingredient can we add to stocks to make our portfolios more diversified, but at the same time make them more profitable while being less risky? That's a question for the ages. Diversification is something that I think is undervalued by a lot of investors. And we're going to look at some cases here. If I have about 5 minutes or more, do I have enough time to go into this?
Oh, yes.
You've got plenty of time, Brad.
Mm-hmm.
Okay, good. So let's look at a case here where we should be able to decide what the best portfolio would be for our needs. This graph shows an imaginary stock exchange. It only has two securities. One is a money market fund, which goes up 0.1% per month, about 1.2% annualized. And the second is a security, which is a boring utility stock or something else that just goes up and down in a trading range from 100 to 85 to 70 to 85 to 100 every month. The question is on the top of the screen. Which asset allocation will give you the highest rate of return? If we know in advance that you've got the money market fund giving you a certain return and you've got this boring utility stock that's stuck in a trading range, if we knew that in advance on this imaginary two-stock exchange, what would we do to allocate our money? A, would you put 100% in a money market fund? B, would you put 100% in security B? C, would you put 50% in A and 50% in B, rebalanced monthly? Or D, it can't be determined what the best portfolio would be given these various criteria. We see at the bottom in the assumptions that it costs us 0.1% for each round trip transaction we make to rebalance our portfolio. So just think, what would you say is going to produce the highest rate of return? A, B, or C, or it can't be determined from the information we have available. I'm going to go to the next slide and show you the answer. The answer is C. Putting half of your money into the money market fund and half of your money into the range-bound security and rebalancing once a month with a fairly low round-trip transaction cost as we have today with exchange-traded funds produces a much higher rate of return than either of the securities individually. Many people think, looking at the previous slide, let's go back to it, that the money fund has a higher annualized rate of return, so the best you can do is put your money in cash. That's not the case. By using diversification in this very simple artificial example, we see that we can make more money out of a 2-asset portfolio by rebalancing, and that is because when the security has gone down in price, it's gone from 100 to 85, or it's gone from 85 to 70, you're taking some money out of cash and you're putting it into the security. When the security has gone up, you are taking some money out of the security and putting it in the safety of cash. Over time, that produces a great return for you, but diversification takes time. If you look at this point that is marked by the circle on the screen, it actually took you more than 3 years before your diversified portfolio was consistently ahead of an investment in security B, which was flat. If you look up here, about 4 years into this 8-year period, it took 4 years before your diversified portfolio was consistently always at a higher balance than just putting your money in the safety of cash. Now, of course, after 8 years, we see that the diversified strategy was making 5% annualized, whereas the money market fund was only making 1.2% annualized. This is the magic of diversification, that by keeping your money diversified and by rebalancing it as needed, that you are able to eke a profit out of the market in a way that is not possible by putting 100% of your money into any asset. Now, as I've said, this is an artificial example. Let's look at one that has random behavior in it, not perfectly predictable behavior. In this example, we have 2 securities, and they're both stocks. They're both volatile stocks. Security C is the purple line on the top here in this graph. It has an expected return of negative 11% per year. Security D is a little worse. It has an expected return of negative 12.8% per year. But they're volatile. They go up and down 15, 20%, 30%, 40% based on random chance of a coin toss. So you can see that over this 4-year period, both Security C and Security D had a loss. They had pretty big losses. They were down about $40 or $42 after this 4-year period because of their volatility, because of their tendency to go down when the coin flips the wrong way. You can see that the Security C did really well. It had a hot streak there in the first 2 years, and then the volatility caught up with it and it fell below its original value. The question at the top of the screen is, should you put 100% in Security C? Should you put 100% in Security D? Should you put 50% in C and 50% in D, rebalanced monthly? Or it cannot be determined given the information available. So we know how volatile these stocks are. We know what their expected return is. We don't know their future path. All we know is that they're volatile and they have expected returns which are not very good. So what would we choose as the portfolio that would be the most profitable in the next 4 years given this information? The answer is C. If you put 50% into Security C and 50% into Security D, and you rebalance your portfolio once a month with the 10 basis points transaction costs that we show on the screen, you actually produce a higher return than either security individually. Now, with random chance, anything could happen. When you're flipping a coin, Security C could have gone up, up, up every month for 48 months. That's usually not what happens. When a security has volatility and a security has poor prospects or a poor expected return, the truth is that you can still extract profit out of securities like that with diversification and with rebalancing. This is not something that we are showing any actual stocks here. This is another imaginary scenario, but this scenario uses actual volatility. It uses actual expected returns that are like a lot of companies that are in the market. They aren't the big companies that shoot the lights out. They're the companies that kind of put along. They're not doing very well. They're kind of gradually declining in value. But with the right strategy, you can actually extract gains out of securities that both have a loss over a 4-year period. Now let's look at our final example using some securities that actually exist that you actually could have purchased. Here we have in the orange line the actual return of the S&P 500 based on index funds like Vanguard VOO. The blue line is an index of US bonds, which is similar to index funds like Vanguard's VCLT, long-term bond fund. And here in this case, we're going to ask you the question, which asset allocation will produce the highest rate of return using the actual historical performances of these two index funds? Would you put 100% in the S&P 500? Or B, would you put 100% in bonds? Or C, would you put 50% into the S&P 500 and 50% into bonds rebalanced monthly? Or D, you cannot determine the answer given the information provided. Think of what your answer would be. 50-50, 100%, 100%, or it cannot be determined. The answer is A. In this case, strictly having a 50-50 portfolio did not wind up with the highest return. Unlike the previous examples, the 50-50 portfolio made 9.8% annualized, as we see in the upper right corner here. The S&P 500 made 10% annualized, and the bond portfolio alone made 8.9% annualized, as we see down here. Now, it's not that the 50-50 portfolio will always underperform. Actually, if you look at the purple line from the bottom to the top, the portfolio that is a 50-50 stock bond portfolio, which my book calls the baby bear portfolio because it's so simple, it's just a 50-50 balance of stocks and bonds, that outperformed the balance in the S&P 500 account in 67% of the months. In about 2/3 of the months, you would have had more money in your purple portfolio that was 50-50 stocks and bonds than you had in the S&P 500 because it's highly volatile, has crashes, has bear markets, and that sort of thing. So as we have seen, there are benefits to diversification, but how can we get the maximum benefits out of diversification? How can we pull a rabbit out of a hat and make ourselves sort of insulated against the worst market crashes? That 50-50 stock bond portfolio only went down about 29% in the global financial crisis, whereas the S&P 500, including dividends and adjusted for inflation, went down more than 50% in the global financial crisis. How can we do a little magic trick here and keep our losses smaller so we can stay with the market all the time, but we are not suffering big losses that are going to be hard for us to recover from for years? One thing to do is to broaden our portfolio universe. We can see that at the top of the screen up here, the S&P 500 is 100% correlated with itself, and small caps, developed market stocks, emerging market stocks, and REITs are highly correlated with the S&P 500. When the index goes down, these other asset classes are very likely to go down. Bonds, like the investment grade corporate bonds and the treasury bonds, are negatively correlated with the S&P 500. When the market goes down, these fixed income assets are very likely to go up. Now, the interesting assets are called alternatives. They're in the middle here. Commodities, with only a 44% correlation with the S&P 500, is really not that correlated with the index at all. That makes commodities very independent of the performance of the S&P 500. Even more independent is a subset of commodities called precious metals. So looking at gold index funds, they only have a 4% correlation with the S&P 500, which is effectively zero. What the stock market does doesn't have any relationship with what gold does. They act completely independently. So when the stock market is going down, it may be that your gold and your precious metals, as well as your commodities, are going up. So we'll look at how that dealt with the actual global financial crisis right here. This graph indicates the global financial crisis from October 9, 2007 to March 9, 2009, about an 18-month period, which was the most severe recession that the United States and much of the world have had since the Great Depression in the 1930s. You can see by the orange line that the S&P 500, adjusted for dividends and inflation, had a 56% loss measured between daily closes. Other asset classes like real estate and small caps and so forth had losses of 60 to 70% in that same period of time, as you'll see at the bottom of the chart here. But look at the other asset classes that we could have had in our portfolio. Treasuries went up 18% during the global financial crisis. Gold and other precious metals went up during the global financial crisis. A gold index fund was up 22% in that 18-month period. Commodities, which are primarily agricultural products and energy, were up an amazing 66% during the first half of the global financial crisis, from October 2007 to July 2008. Now, you need to have a mechanical formula to decide what your portfolio should have in it. You want to tilt your portfolio towards those asset classes that are in uptrends and tilt your portfolio out of those asset classes that are in downtrends. How do you determine that? With a mechanical formula. The reason is that you wouldn't want to be in commodities for this entire 1.5 year period. At some point, people around the world realized that there was a huge recession that was upon us, and there was going to be less demand for industrial products, for agricultural products, for base metals, and so on. And so the commodities index actually wound up 20%, 28% lower at the end of the global financial crisis than it started. So if you had a mechanical formula that could tilt your portfolio toward commodities when they were in an uptrend, and as soon as it lost its momentum and went into a downtrend, you would keep your assets away from commodities. That is how you can make money even in a bear market if you know the formula. Now, all of this and all of these charts are in my book, Muscular Portfolios, and they're in articles on stockcharts.com, which start at this URL, bri.li/190319. So write that down. I think people can learn a lot about not putting all of their eggs into one basket, having diversification, having a set of asset classes out of maybe a dozen. You want to invest in at least 3, and you want to invest in 3 that are in uptrends as opposed to in downtrends. That is not a secret. The formulas have been published by many academic researchers in white papers that are on the internet. But who has time to read all of these white papers? Well, I did. I read over 1,000 papers and strategies that have been proposed, and the ones that have the most veracity, the ones that have the most predictability are in the book, and they're in my columns in stockcharts.com. They don't work in a year. You won't beat the S&P 500 every year. The point is to beat the S&P 500 during our lifetimes. And you do that by beating the S&P 500 over every bear bull market cycle. That means if you're going to live another 8 years, you're probably going to experience a bull market and a bear market within that space of time. And we'd better get good at it, because with the market at all-time highs, it is just as likely to go way, way down as it is likely to go way, way up. And we need to be cognizant of that fact. I'm going to go into some other stuff about probability, but I don't mean to keep us over time if we're going to take a break or anything.
Yeah, we're going to have to close this off, unfortunately, but I did have one other question that came in, and it is about what you had talked about earlier. And it says that, you were discussing managed funds and, money managers, and, they wondered how the hire fire idea works, with ETFs, which are, different from that managed fund. Is this, they're asking, is your message to buy the worst performer? Which I don't think it really is.
That's a very good question. What we know about ETFs, they work like mutual funds. They work like individual stocks to some extent. And our human minds are of the programming that leads us to reject what has underperformed in the last 3 years and to outperform. Those ones that we rejected from the last 3 years' performance are likely to outperform the funds that we choose to buy instead. That's just the way the human mind works. Now, I did show you this graph, which showed that the strategy of following investment strategies that had done the worst in the last 3 years produce the highest return in the next 3 years. I am not recommending that. I recommend that you read the article that was in my tiny URL and see what it is that the researchers actually found. I think it's too stressful for individual investors to be so contrary that they put their money into something that did the worst in the last 3 years. That would be something that you would have to have nerves of steel. You would have to have cold water running in your veins instead of blood to do that and be a human being. It just rubs us the wrong way. It goes against our grain. What we should do is the asset classes that are going to do well in the next 30 days are those that have done well in the last 3 months to 12 months. This is a very strong tendency. It's called momentum or relative strength. And so my columns and my book, Muscular Portfolios, show how to use that, because what you're doing is you're buying high and you're selling higher. I think that's a much easier policy for individual investors to follow, because look, this thing has gone up in the last 5 months. Look, this thing has gone up in the last 12 months. You're buying into strength. So a purely contrarian strategy is very easy for academics to say, oh, look, if we did what performed worst in the last 3 years, we would do the best. Well, yeah. And if I drove my car backwards, I might be able to go faster down the freeway, but that would be a risky and a scary maneuver for me to do. Let's do something that's easy for individual investors to do. Let's do something that has them buying into strength. Read the report, and if you choose to invest in the things that did the worst in the last 3 years, fine. But these are academic studies. They are not real people with real money who had to live with their real emotions.
Exactly. That does make a little bit of a difference, I would say. Well, it does look like we are ready for our 10 and 10, but I just wanted to thank you for coming by and giving us that presentation. I know a lot of people were interested because when I get fewer requests for the 10 and 10, I know that people are watching. So, and this is the info to get a hold of you?
Yes, I recommend that people type in bri.li/MP. This is a cloud server that I own, and I use bri.li to make short URLs for people so they can just type in a short web address and go right there. That takes you precisely to muscularportfolios.com. If you prefer to type in that long URL, be my guest. And there you will find the free newsletter that you can get. You'll find the book, which is at Amazon and Barnes & Noble and every other bookstore in the country. And a lot of free information that I've put out that shows people exactly how mechanical investing works, exactly what they can buy and sell right now. It's the first website that gives away the signals for free of what Wall Street knows you can buy and sell without you paying 1%, 2%, 3%, or more of your life savings every year to some advisor who isn't going to do any better for you than you can do for yourself.
Yeah, it is your own money, after all.
After all.
All right. Well, thanks again for coming in. Tom, I'm going to bring you back in. It is time for that 10 and 10.
Yep, I do. Well, I also want to thank Brian for stopping by. I really appreciate it. Great presentation today. And I don't know if you, we do need to move on, but I don't know if you do anything with currencies, Brian. But I know currencies can impact the price of some of those ETFs, especially foreign ETFs. And just wondering, maybe, I don't know if this could be a future topic for you to come on and talk about, but I was just curious as to the dollar and how that might impact some of your diversification strategies.
Yes, currencies are very interesting. Studies show that more than 70% of currency traders lose money. This is in a chapter of my book, Muscular Portfolios. We don't want to go into it today, but because you're betting that one currency is going to go down and another currency is going to go up, if you just made trades at random, you would have a 50% chance of being right. Unfortunately, our brains make us wrong in 70% of the cases. Currency traders go broke within a year or not even that much, because they're guessing about behaviors that act in ways that our human brain simply interpret wrongly. So I know that there is money to be made in currency trading, and I don't know if a lot of individual investors have the stamina to be able to do it.
Yeah, I know you had talked about commodities, and of course, some of these ETFs, especially foreign ETFs, currencies do have quite a role in some of that. So I think maybe that would be a good topic though for a future presentation of yours, if maybe you give that some thought.
Sure.
Okay. Well, it was great having you on here again, and we look forward to having you back again soon.
Thanks.
All right. Thanks, Brian.